Okay, now that we've reviewed perpetual and periodic inventory systems and discussed what the purchase side of buying inventory looks like for a company, let's look at what the sales side of handling those transactions looks like under the perpetual inventory system. Now it says here that we should report our revenues when they're earned in accordance with the revenue recognition principle. And so for a merchandising company, we earn our revenues when we actually transfer the merchandise from the seller to the buyer. And then obviously all sales should be documented by some sort of cash register tape, sales invoice, something else. We always want to try and document our work so we have a backup and we can prove what actually happened. So if we're selling merchandise, and again remember this is a perpetual inventory system, and I'll explain why here in just a second. We debit cash or accounts receivable if our customer is going to pay us in the future, and we credit the sales account. Now this is something we've essentially been doing now for a few weeks. Go ahead and debit cash if they're going to pay us in cash. Debit the customer's account, accounts receivable. Those are both assets, and they're both going to go up when we debit them. And then we credit sales revenue. This has the impact of increasing our sales or our net income ultimately. Now the second part of this journal entry here will not occur if it's a periodic inventory system. So if it's a periodic inventory system, just ignore these last two items. But under perpetual, in the same time when we make the sale, we're going to go ahead and take the merchandise out of our inventory. So we're going to credit inventory for the cost of that merchandise. And we're going to debit cost of goods sold, which is an expense, for, again, the cost of that merchandise. And then what we get left with, if you remember your basic format of your income statement, revenues minus expenses, revenues of $3,000, expenses here, $1,900, give us $2,100. Now this particular expense is actually cost of goods sold, and if you remember, revenues minus cost of goods sold give us gross profit. So now this particular company made $2,100 on that sale, so they have $2,100 left to go ahead and pay all of their other operating expenses and to hopefully earn some net income along the way. Now let's talk about what happens when a customer returns merchandise. So sometimes they buy something, they don't want it anymore. So if they bring it back to us, we're going to create a new account called Sales Returns and Allowances. So sales returns when the customer is just not happy and they bring it back to us and we give them their money back or give them credit, store credit. Sales allowance is actually where we discount the price for a particular reason. I had an example once when I was working at the Home Depot. A customer wanted to buy a special order sink and it had a scratch in it. So I ended up giving her a discount of like $100 or $150 on her sink because it was damaged. She didn't pay full price for it. That was an example of a sales allowance. Now, sales returns and allowances, it's going to be a new account for us, and it is what's called a contra revenue account. And anytime you hear this word contra, it means opposite. So, sales returns and allowances is a contra revenue account. Well, revenue normally carries a credit balance. In this case, sales returns and allowances carries a debit balance. It's opposite of the sales account, contra revenue account. So it carries a balance opposite of revenue, which normally will carry a credit account. So when a customer returns merchandise, instead of debiting the sales account and just doing a reversal of that journal entry, we're going to debit this account called Sales Returns and Allowances. That's going to help us keep track of the returns and allowances that we have coming back. This is particularly important if it's a particular product or something that we may be able to go back to our own supplier and say, hey, we're getting a lot of returns on this product. So we'll debit sales returns and allowances, go ahead and credit the customer's account. You may sound familiar to you if you take merchandise back to Target or Walmart, and they say, oh, I'm going to credit your account. That's where that comes from. They're crediting your account. Now this is at what the customer paid for us at $75. Then we need to put that merchandise back on our shelf. So we go ahead and we debit inventory, which increases our inventory for cost, and we credit cost of goods sold here, which will decrease our actual expense cost of goods sold. And now remember, this is at cost, and this is at retail. Here's an example. If the customer paid with on account rather than paying for cash, we go ahead and credit their account right there. Oh, no, sorry. I misunderstood the example. This is an example where we give them an allowance. We're not giving them a return, so there's nothing to put back in our inventory. This is an example of allowance. We debit sales, returns, and allowances for $100, the amount of the discount, and we go ahead and credit the customer's account. Now, we may also be able to take advantage of a discount. Remember, before we had the purchase discount. Now we can have a sales discount, which is again when a supplier is offering us a discount for prompt payment. And we're going to create another new account called sales discounts. This is a contra revenue account, and it carries a normal balance. So again, contra revenue, well, revenue, sales, normally carries a credit balance. So a contra account, again, is an opposite, so it will carry a debit balance. It's going to reduce the balance of our sales on our income statement. So here's an example where we owed $450, or we purchased $450 worth of merchandise. Apparently we got to take advantage of the discount, so we only have to pay $441 for that particular item. $450 cost minus the $9 discount is $441. So we debit cash for the amount we're going to be receiving. Oh, excuse me. We're offering the discount in this case to our customers of $9. So we're only going to receive $441. The customer gets to take advantage of a $9 discount. We're going to record that under that contra revenue account sales discount. So again, we can keep track of the amount of discounts that we're giving to our customers. And then we'll go ahead and credit the customer's account in full for the amount they owe for the merchandise. One last topic is going to be freight. So if we buy merchandise and we have to pay for the freight, or the seller pays for the freight, that's something that we need to determine before we make the purchase. And there's two different types of ways that we can account for the cost of transporting the merchandise. One is called FOB shipping point. FOB stands for free on board. In this case, buyer pays the freight. They take possession once the seller gives it to the transportation company. FOB destination is when the seller pays the freight. So here's another graph of that particular. So if it's FOB shipping point, buyer takes possession here at the seller's loading docks. They have possession of that merchandise and they pay the freight. So for example, the UPS company or FedEx or whoever gets in an accident on the way, the buyer who has control of that merchandise is the one who will file with that particular transportation company. It also will be included in their inventory for inventory purposes, even though it's not actually at their location. If it's FOB destination, the seller's going to pay the freight, and they do not take advantage of that, or they do not give up possession of the inventory until it reaches the buyer's loading docks. So they have control, the seller does, through the entire process until the buyer takes possession at their own loading docks. Now, if we are buying merchandise and we have to pay the freight, we debit merchandise inventory. If we're selling merchandise and we have to pay the freight, that's delivery expense. The reason we include it when we buy the merchandise, let me give you an example. Let's say you buy a textbook and it costs you $100, but you have to pay freight of $5 to get it to your home. Well, it's actually costing you $105. So if that's the case, we debit merchandise inventory for the $105, the cost of getting that book to us, so we could turn around and sell it. However, let's say now we want to go ahead and sell that book to someone else, and we're going to sell it for $100, and we have to pay the freight of $5. Well, the book still cost you $105, but you're going to sell it for $100. It has no impact on what the actual cost of the merchandise was to you when you go to sell it. So in that case, we debit delivery expense for the cost of that merchandise.